Good afternoon and a happy new year to you all. I am delighted to be here today. Now, 2022 was a challenging year. To the climate, to the geopolitical situation, and to the global economy. We were yet again reminded that peace and stability cannot be taken for granted. Greenhouse gas emissions are still on the rise, and climate change is increasingly affecting the global economy and societies worldwide. Geopolitical tensions are impacting trade and beyond. And the war in Ukraine is causing terrible human suffering as well as severe economic disruptions. At the same time, the pandemic and food and energy shortages have amplified the trend towards rising inequalities. 2022 has also been a challenging year for central banks. Inflation has surged to multi-decade highs, and to bring inflation down, central banks, including Norges Bank, have responded by raising the policy rate faster and in larger steps than normal. So high inflation, monetary tightening, and geopolitical tensions are also impacting financial markets, and by implication, Norway's sovereign wealth fund. As the chair of the executive board for the fund, I want to take this opportunity today to talk to you about the importance of resilience and robustness in times of change. Resilience and robustness, both financial and operational, are of particular importance to the Sovereign Wealth Fund, given its paramount role in managing the savings of the Norwegian people. But let us start from the beginning. On the 30th of May 1996, the then Finance Minister, Sigbjørn Johnsen, made the first capital transfer of almost 2 billion Norwegian kroners to the fund. Since then, a net amount of 3 trillion has been transferred to the fund. And since the first transfer, the fund has returned more than 6 trillion, bringing its current value close to 13 trillion, or close to 4 times our mainland GDP. So how did a small nation up in the far north end up with the largest sovereign wealth fund in the world? Most likely, the answer lies in a mix of good policy decisions and good luck. From the outset, the fund was only invested in government bonds. The decision to invest 40% of the fund in equities was made in 1997. And this was a bold decision. At that time, both the Ministry of Finance and Norges Bank had limited experience with global equity investing. The equity share has since been increased in steps and is now 70%. And the choice of equity share is the most important decision for the return and risk profile of the fund. And a 70% equity share signals that the asset owner is willing to accept a fair degree of annual return variability in exchange for higher expected returns in the longer term. The experience from last year, when the fund lost 1,680 billion Norwegian kroners in the first half of the year, illustrates this. Over the years, the fund's investment universe has been broadened to include other asset classes, such as real estate and infrastructure for renewable energy, and new geographies and segments. Today, the fund is invested in over 70 countries and in thousands of stocks and bonds. A key premise underpinning this strategy is that overall risk can be reduced by broad diversification. But by implication, this means that the fund is exposed to the world economy. What happens in the world affects the fund. Now, the earlier period of large inflows to the fund featured favorable global economic conditions with strong company profits and high returns for the fund. But we have also experienced periods of turmoil in financial markets. In 2008, the fund's return was down 23%. And during this period, the fund was a large buyer of equities, following the ministry's decision in 2007 to increase the equity share from 40 to 60%. When markets started to collapse in 2008, the media did question how much we could handle losing. But the decision to increase the equity share was not revoked. Which brings me to one of the key points I want to make here today, namely the importance of anchoring strategic decisions in different parts of the governance model. For the fund is owned by the Norwegian people, represented by the government and the Storting. The overall responsibility for the fund is delegated to the Ministry of Finance, while the daily management of the fund has been delegated to Norges Bank. The fund's investment objective is to achieve the highest possible return after costs. And within the scope of the financial objective, the fund shall be a responsible investor. Now, the fund's overall investment strategy is defined in the management mandate issued by the Ministry of Finance. The management mandate specifies which asset classes the fund can invest in. It defines a benchmark index and lays down certain constraints and requirements. Norges Bank contributes to the development of the fund strategy through its role as an advisor to the Ministry of Finance. And importantly, material changes to the fund's overall investment strategy are presented and discussed in the Storting. The governance model ensures democratic legitimacy in matters concerning the management of the fund. It has made the fund's strategy robust in periods of crisis, and we have been able to stick with important decisions through periods of volatile markets and financial losses. This will become no less important going forward. In 2021, the Ministry of Finance appointed a commission to examine international economic and political developments that may affect the fund. The commission, led by Ulf Sverdrup, submitted its report in September last year. Now, the commission considers that the management model, with a clear division of responsibility between political authorities and Norges Bank as the operational manager of the fund, has worked well. Moreover, the Commission believes that the principle that the fund should be as broadly diversified as possible should be retained. The Commission also points out that good financial returns and responsible investment are important for the fund's legitimacy, both nationally and internationally. At the same time, it is important to have realistic expectations for what the fund can achieve. Norges Bank shares the Commission's overall assessments. We do manage the fund with the aim of achieving the highest possible return over time within the framework set by our mandate. And we attach great importance to being a responsible investor. Responsible management and active ownership contribute to long-term value creation and thereby our goal of the highest possible return. And by ensuring the greatest possible transparency about the management of the fund, we seek to contribute to realistic expectations of what the fund can achieve. At the end of last year, Norges Bank's executive board adopted a new strategy for the fund for the coming 3 years. The strategy builds on previous strategies and elaborates on how Norges Bank will fulfill its management task and in what direction the organization will move going forward. To succeed in challenging and competitive markets, the Executive Board believes it is important that the fund's investment strategies are tailored to the fund's characteristics as a large fund with a long investment horizon and limited short-term liquidity needs. The size of the fund offers economies of scale and makes the fund an attractive business and trading partner and can provide investment opportunities not necessarily available to other investors. While the long investment horizon ensures that the fund can withstand large fluctuations in the fund's value and enables it to act differently from other investors in stressed and illiquid markets. Now, in the following, I will highlight 3 topics from the strategy: investments, climate, and operational robustness. Central to the management mandate from the Ministry of Finance is the benchmark index consisting of 70% equities and 30% bonds. And Norges Bank manages the fund close to this index. In the daily management of the fund, Norges Bank has 3 main investment strategies: market exposure, security selection, and fund allocation. These investment strategies complement one another. We do not expect all 3 strategies to generate excess returns at all times. The largest part of the fund's portfolio is managed internally through the market exposure strategy. And the main purpose of this strategy is to achieve the exposure following from the benchmark index as cost efficiently as possible. Now, the fund is invested broadly in the companies and bonds in the benchmark index, but seek to avoid the pitfalls of mechanical benchmark replication. For a large fund managed close to the benchmark index, it is critical to manage and trade the portfolio efficiently. And this could become particularly important going forward with potentially large capital flows in and out of the fund combined with large market fluctuations. The security selection strategy is based on fundamental company research. The fund's internal and external portfolio managers are specialists who have built strong skills in collecting and analyzing information. Specialized expertise and delegated authority are key components of this strategy. And the third strategy is fund allocation. Through this strategy, Norges Bank seeks to improve the fund's total return risk profile. Investments in real estate and infrastructure for renewable energy, which is not part of the benchmark index, are part of the allocation strategy. Now, Norges Bank has grouped its management of the fund into these 3 main strategies since 2013. The Executive Board is satisfied with the overall results. The fund has outperformed the benchmark index by 30 basis points since 1998. But going forward, we must be prepared for considerable fluctuations in the fund's return and market value. This follows from an equity share of 70% and from the substantial size of the fund. Now, this graph shows the expected variability in the fund's annual returns in 2 out of 3 years. As shown by the dark blue line, the expected variability in the fund's value has fluctuated around 10%. But as the fund has grown in size, the expected variability in terms of Norwegian kroner has increased, as shown by the light blue line. The latest update from Norges Bank Investment Management shows that in 2 out of 3 years, we must expect the fund's value to vary by about 1,200 billion Norwegian kroner. And remember, this is under normal market conditions. The question then is, what can we expect in stress markets? To assess potential losses in stress times, NBIM also conducts historical and forward-looking stress tests. And for a global portfolio consisting of 70% equities and 30% bonds, historical analysis indicates annual losses in stressed periods as high as 33%. Now, a drawback of historical simulations is that future crises may play out very differently from historical crises. So to assess the potential implications for the fund's portfolio under a range of potential adverse scenarios, the NBIM has been conducting and publishing forward-looking stress tests since 2017. So to estimate the potential portfolio impact of hypothetical forward-looking scenarios, different narratives are translated into shifts in important return drivers, such as expected dividend growth, real interest rates, inflation expectations, and different risk premiums. Examples of narratives could be a slowdown in global growth or real rate normalization. As it happens, these two scenarios were part of last year's stress tests published early in 2022, and which turned out to be highly relevant. The management organization has since then worked on a set of updated scenarios shown in this graph. Here we see the potential portfolio impact of 3 hypothetical scenarios: a geopolitical conflict, a persistent increase in global inflation expectations, and a sharp increase in real rates. These are hypothetical scenarios. The effects are highly uncertain, but the stress tests show that we must be prepared for large fluctuations in the fund's value. At Norges Bank, we continuously work to strengthen our understanding of the world, to make the fund better prepared to handle serious incidents and crises. It is, however, important to recognize that it is inherently difficult to identify these types of events before they occur or before they have resulted in financial losses for the fund. It is also important to note that Norges Bank will not be able to change the portfolio significantly should a crisis or adverse scenario occur. We cannot shield the fund from all possible outcomes. Volatility is the normal state of financial markets, and nor are there any guarantees that markets will recover quickly after a fall. The fund is invested in a wide range of assets, countries, and companies. We can therefore benefit from broad-based market upturns, but we must also ride out the downturns. But we do have an important responsibility ensuring that the portfolio is as resilient as possible should a crisis occur. And this brings me to the next topic, how Norges Bank will work over the next 3 years to drive the companies in the fund is invested in towards net zero by 2050, and thereby increase portfolio resilience. For the fund's returns in the long term depend on sustainable developments in economic, environmental, and social terms. The government's ambition, as stated in the Hurdal-plattform, is that Norges Bank's investment organization should be the global leader within responsible investments and handling of climate and nature risk. This has in fact been a priority for the fund over the past 15 years, but there is still a way to go. And last year, the Executive Board approved the fund's new Climate Action Plan. The first important point in the action plan is that all companies are required to set credible targets and transition plans for reducing their emissions to net zero. And they have to do so by 2040 at the very latest. Now, this might seem late, but currently only 10% of the companies in the portfolio has set zero targets. The second point is the ambition to be an active owner and engage to change through dialogue and voting. To begin with, the engagement will focus on the largest emitters. At the end of 2021, 174 companies accounted for 70% of Scope 1 and Scope 2 emissions in the equity portfolio consisting of 9,000 companies. Now, our aim is to support, but also challenge these companies to get reliable and measurable plans and actions for emission reduction. And the last point is transparency about progress. The plan also commits to report on the progress of this work. One of the initiatives is an interactive tool on the fund's website that allows stakeholders to explore the fund's financed portfolio emissions. So far, I've focused on financial resilience. Preserving the values in the fund also requires operational robustness. Only 600 people manage 13 trillion Norwegian kroner. And the operation is spread across the world, Singapore, Oslo, London, and New York, in order to cover different time zones and to be close to markets. This collaboration needs to go seamlessly between time zones and teams within the fund. And technology is at the core of every process. More than 100 employees work with technology in the fund. As much as 98% of all transactions in the fund are automated. And we use technology to increase robustness, quality, and efficiency through data, analytics, and automation. And as highlighted also by the Sverdrup Commission, internet, cloud, and digital platforms and the handling of large amounts of data are important factors for the fund's success. But as we all know, digitalization also represents a risk. It makes the fund vulnerable to people or states with bad intentions. Cybersecurity has been and will continue to be a priority for the Executive Board. If the fund experiences a cyber attack or a power outage or any other disruptions, the organization needs to have people and processes to handle that immediately. But no matter how hard you work to avoid errors, operations can fail, and people will make mistakes. An important part of operational robustness is to learn from that and to improve. Building psychological safety and diverse teams are important factors for strengthening operational robustness. I started out by talking about the importance of resilience and trust in a changing world. This will be a high priority for us going forward. And to maintain and build trust, transparency is key. And this includes transparency about risk. As I have shown, we must be prepared for both large fluctuations in the fund's value in normal market conditions and large potential losses in adverse scenarios. As a long-term investor, it is important to be able to stick with key elements in the fund's overall investment strategy during periods of stress. And changes to the fund's strategy should be rooted in thorough processes and political anchoring in the Storting. The governance structure of the fund has served the fund well, and I'm confident that it will continue to serve us well, also in a more challenging world. Thank you.
Thank you so much, Ida, making history as the first woman to govern Norges Bank. Please. I invite you now to have a seat over here, and I'm going to introduce the woman who is going to interview you. And she is right here, the investment director of SKAGEN Funds, Alexandra Morris, please.
Good afternoon. Good afternoon, Ida.
Thank you.
Thank you for a very insightful presentation. Let's go to the questions. Norges Bank Investment Management has clearly stated that transparency is of utmost importance. Why is that? And what does it actually mean in practical terms?
Now, the executive board puts great emphasis on transparency, as you say. We manage the fund on behalf of the Norwegian people. And fundamentally, transparency is about democratic accountability and legitimacy. So we owe it to our owners and to the public to be transparent about the management of the fund. We also believe that by being open and transparent, we build knowledge. And higher knowledge builds trust. So we believe that that is key to the fund's success and legitimacy over the long term. It is also a pillar in our active ownership strategies. So we want to be open about the expectations we set for the companies that we invest in. We are open about our voting intentions, and we want to report on the progress of that work.
Thank you. I think we are all very grateful that you are open, and we're looking forward to reading more in the future. Now, from the time of inception of the fund, it has been clear that the objective has been a financial one, to achieve the highest possible return after cost with acceptable risk. Now, but shortly after Russia invaded Ukraine, the Norwegian government instructed the Norwegian fund, sovereign wealth fund, to freeze funds and make plans to exit the country. Now, can we still say that the fund is not a political instrument? And how do you regard the probability of similar decisions in the future in this world of heightened geopolitical tensions?
Well, the decision to exclude Russia from the fund's investment universe, it was a political decision. It was made by political authorities, and I believe rightly so. And I agree also with the Sverdrup Commission that we cannot rule out that similar events will occur sometime in the future. Should it be deemed desirable for ethical or political reasons to exclude or restrict the fund's investments in certain companies or countries, we believe that this should be reflected in the fund's benchmark index. But this is not to say that the fund should be used actively as a political tool. This was a very special situation. We manage the fund with the objective of achieving the highest possible return after costs, and we believe that it is critical for the fund's financial success that it is not seen as a political tool by investors and authorities in other countries, so that we also can benefit from free and open capital markets without restrictions on our investments.
Right, so let's hope it was a one-time event and the atrocities will soon end. Going on to the next question, in your most recent strategy document, you state that as a long-term investor, you are well placed to take advantage of variations in asset prices. And specifically, you stress the importance of avoiding herd behavior and the daring to be contrarian. Mm-hmm. Now, to achieve this, you will promote psychological safety for your portfolio managers. Mm-hmm. Now, we all know that excellent portfolio managers have a hit rate of just over 50%. So, what should leaders do to promote psychological safety, and why is it important?
Well, this is something that I believe is truly important for all organizations. It is important for a central bank, but it is also important for an investment organization like the NBIM. I think both as individuals and as teams, we perform better and we thrive in an environment that is safe, where it is safe to express one's opinions, where we give each other feedback, and not least, where we learn from our mistakes and improve. And as you say, we make mistakes all the time as portfolio managers. So we think this is essential to create a robust culture that makes the right decisions and to avoid groupthink. And I think as managers and leaders, we should be role models in this. We should be open about our own mistakes and allow others to learn from our mistakes as well. And we should encourage feedbacks from the people around us.
I think those were wise words. I agree with that. Now that the fact that the fund manages parts of the portfolio actively has been heavily debated over the years by academics. Maybe less so in the last few years because of the excellent excess return that you have shown. Now, in your strategy, you state that the active risk-taking will change with as the market changes. Now, apart from the obvious contrarian actions, are there any reasons to believe that active strategy will be even more successful in the future?
So I will not speculate on the active returns in the future, but rather restate that the Executive Board is satisfied with the results that the NBIM has delivered over time, outperforming the benchmark index. I also think that it is important to remember when we discuss returns that it is really the absolute returns that matter. And the fund is managed close to the benchmark index, and the absolute returns from the fund follow from that benchmark index. So I think in a changing world, it is important that we continue to develop the overall investment strategy for the fund. And as I mentioned earlier, the Norges Bank contributes to this through its role as an advisor to the Ministry of Finance, because obviously these are political decisions. We wrote in our consultation response to the Sverdrup Commission that there are more and more signs that an increasing share of global value creation is now happening outside listed markets. We have observed that the unlisted market has increased in size relative to the listed market. We observed that the number of listed companies worldwide has leveled off, and companies are older and larger when they list. So I think these are trends that one should consider reflecting in the fund's investment strategy.
Right, so we will see more investments in alternative markets going forward then maybe. Now to the last questions, a topic that is close to my heart. Women in Finance Charter, where signatories such as yourselves set their own goals for gender diversity. Norges Bank's goal is to have 40% female employees, also in senior leadership and senior front-end positions. You still have some way to go. What are you doing, and what are you planning to do to achieve this?
Well, we are making progress, but as you say, there is still a way to go. And let me just thank you and SKAGEN for being promoters of this important initiative. I think we have to do a variety of things. First, I think we have to increase the visibility of the highly competent and successful women already in our organizations and in Norges Bank in particular, both externally and internally, because there are a lot of them. And I think we have to communicate to young women and young men and tell them about all the exciting, meaningful and challenging job opportunities that we can offer. And then, of course, we have to encourage women to seek leadership roles. We have to remove any unconscious biases in our recruitment processes. And hopefully, and this is something that I know that the CEO of the fund cares deeply about, and I am confident that we will be making even further progress in the years to come.
I'm confident too. Thank you. Ida, thank you very much.